Now we move into section 6.2, the cost equation. The cost equation is a mathematical function that predicts expenses at a given production level. It is used to estimate costs, profit, break-even points, and sales targets. The cost equation is total cost equal fixed cost plus variable cost per unit times units of production. This equation is the foundation of cost volume profit analysis. Here is an example. Sharp's Daylily Farm sells premium flowers at 48 cents per stem. Direct variable costs are $8 per 100 stem bundle. Fixed costs are $50,000. If the farm produces 5,000 bundles, the total cost is $50,000 plus $8 per bundle times 5,000 bundles, or $90,000. This shows how we use the cost equation to estimate total cost at a specific activity level. Now we introduced cost volume profit analysis. CVP analysis evaluates how changes in sales volume impact costs and profits. One key goal of CVP is to determine the break-even point. The break-even point is the sales level where total revenue equals total cost, meaning profit is zero. CVP analysis makes several assumptions. One, costs behave linearly. Costs can be classified as fixed or variable. All units produced are sold, and sales mix is constant if multiple products exist. Now let's take a moment to visualize the cost volume profit graph illustrated in your textbook. Notice the break-even point is at the intersection of the total sales line in red and the total cost line, the dashed line, in green. The difference above the break-even point between the lines is profit, and the difference between the lines below the break-even points is loss. Here is an example of break-even using an auto manufacturer. An auto manufacturer produces 10,000 cars and sells each for $20,000. Fixed costs are $25 million. Variable costs total $99.55 million, which equals $9,955 per car. Now let's calculate break-even in units. Use the cost equation formula and set profits to zero. In the break-even formula, we're going to compare contribution margin, or the total contribution, to the total fixed costs. And the contribution margin is the difference between the sales price of $20,000 per car and the variable cost. That results in $10,045 of profit per car that is available to cover fixed costs. If we take that contribution margin, the $20,000 minus the $99.55, or $10,045, and multiply it by units sold, at a break-even, we would cover all of our fixed costs of $25 million. Solving for units sold, we find that the result is 2,489 cars to break even. Break-even sales in dollars is approximately $20,000 per car times 2,489 cars to break even, or $49.78 million in sales. Let's take a look at Learning Activity 6.5. Hudson's Textiles expects to sell 500,000 garments. Sales are $6 million. Variable costs are $3.2 million, and fixed costs are $1,960,000. You're asked to compute break-even garments and break-even sales in dollars. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 6. Let's get a better understanding of this concept of contribution margin. Contribution margin is the amount of revenue remaining after variable costs are deducted. This amount is what is available to cover fixed costs and then contribute to profit. The contribution margin per car in our previous example was again $10,045, the difference between sales minus the variable cost. Break even using contribution margin is equal to the fixed costs divided by contribution margin per car. Now let's discuss the contribution margin ratio, which is the percentage of sales dollars available to cover fixed costs and profits. The calculation is contribution margin divided by net sales revenue. For example, the contribution margin we just calculated in our previous example of $10,045 divided by the sales price of $20,000, if we're looking at these on a per unit basis. So the contribution margin ratio per car is 50.23%. This allows you to compare contribution margins of different products to maximize resources. Let's revisit the Hudson Textiles example and Learning Activity 6.6. Using the Hudson Textiles data, compute contribution margin, then compute the contribution margin per garment, then use contribution margin to compute break even. This is often the easiest way to solve break-even problems. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 6.